This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on trading breakouts. I want to begin by talking about bull breakouts, and then I want to talk about a particularly strong type of bull breakout, and I call that a buy the close bull trend. The bull breakout is so strong that it has a series of consecutive bull bars closing at or near their highs, and traders are buying at the market, especially at the close of a strong bull bar. Finally, I'll talk about sell the close bear trends. These are bear breakouts that have 2, 3, or 4 consecutive bear bars closing at or near their lows, and traders are so confident of lower prices that they're selling at the market, especially at the close of a strong bear bar, a sell the close bear trend. This is a 5-minute chart of the euro versus the dollar, and we have a series of 8 or so bull bars, many of them closing on their highs, breaking above a trading range. This is a strong bull breakout. Let's look at the close of this bar. At this instant, if you had to take one of 2 choices, what would you do? Buy, looking for a measured move up with a stop down here, or sell, looking for a test down here, using a stop at a measured move up. For the bulls, will they buy here, exit here, putting a stop down here? For the bears, will they sell here, take profits down here, and put a stop up here? The risk and reward is the same for the bulls and the bears, but what's different? There's a third variable in the trader's equation, and it's probability. After you have a strong bull breakout like this with good follow-through all the way up, probability is high that you're going to go up for a measured move based upon the height of the breakout. And therefore, high probability, that means 60% or more, that you're going to get here before you get here. That means that the trader's equation is very good for the bulls buying this close, putting a stop down here, and exiting with a reward equal to their risk. Now, this is a reward equal to the risk. In general, traders should be going for a reward twice as big as their risk. The one exception to that is this, when you have a high probability trade. And this is a high probability trade. For the bears, they're selling here, stop, measured move up, and target down at the bottom of the bull breakout. You can either buy here or sell here. Clearly, it's a better trade to buy. It's more likely to go here than it is to go here. And therefore, if you had to buy or sell at the close of this bar, and you had to use targets and stops here or here, you have a much better chance of making money if you buy. Easier to make money buying. You don't have to wait until this close to buy. Once you start to see 3, 4, 5 bull bars, a bull breakout and a follow-through bar, you know the market's always in long. You know the market's probably going higher. Once you decide that the market is going to go up, you have to buy. And if your stop is too far, you have to simply trade very small and you have to buy. And you can buy for any reason. This is what followed that strong bull breakout. Early on, you want to get long, and you have to look for signs that the bull breakout is going to be strong. Here we have a pair of consecutive bull bars, breaking above the high of the past 30 bars, and now we have another good bull bar, and then a good follow-through bar. You have a series of bull bars closing near their highs. Probability is that we're going up for at least a measured move based upon the height of either this series of bull bars or this entire series of bull bars. Here we have 8 consecutive bull bars, many closing on their highs. A strong bull breakout. Closing on their high or small tails on the tops of the bars, strong breakout. At some point after maybe 4 or 5 of these bars, after the breakout above the trading range, follow through bar, traders start buying for any reason. And one good way to buy is simply at the market or on the close of a bar. The context supports higher prices. A very strong breakout, very good follow through after a breakout above a protracted trading range. Although you cannot see the bars to the left, this is what took place. We had a very strong bull breakout, a trading range. We have a double bottom. If you want, you can call it a wedge. It slopes slightly downward, and this purple line right here is right here. And this is the start of the breakout above the bull flag. The bulls have a strong bull trend, a very long trading range, 100 bars or so, and now we're starting to get trend resumption up. Bulls will look for leg one, leg two, measured move. Leg one, pull back, leg two. Look at this chart. It's maybe 100 bars, maybe more. Whenever you look at any chart, only about 5 to 10% of the bars on the chart are in a strong breakout at the start of a trend. Most 2 to 3 bar breakouts do not result in a big trend, and they usually reverse. Only about 5% of the bars on any chart are at the start of a very strong trend. This is those 5 bars. So you have to be prepared to recognize it and to buy. When did it become always in long? It probably became always in long with this 4th consecutive bull bar, maybe the follow-through bar after this bar. This bar is a breakout above the trading range. You're getting consecutive bull bars closing on their highs. That's a sign of strong bulls. You have a bull breakout above a trading range, another sign of strong bulls. You have good follow-through bull bodies after the bull breakout. That increases the chances that this is the start of a bull trend. You have another strong bull bar, so another bull breakout. And again, good follow-through. The context is good for a rally, and the breakout is very strong. The odds are the market's going higher. Although you cannot see it, you can argue that this is a higher low major trend reversal. I showed it on the other chart. There are many ways to get long. You simply have to choose one. And if you cannot decide what to do, you just buy at the market. At some point in here, you're thinking, oh my gosh, this is going up. How do I get long? If you spend more than a bar or two thinking about it, simply buy at the market. You know where the stop has to be, down here or at the bottom of the bull trend, and you just trade small enough so that you can afford the loss if the market goes against you. But the probability is high that it's going up. Another choice is you can press bets. You can buy breakouts above prior highs, betting that the bears will not sell the breakout above the prior high. You can also buy the close of any bull bar. Different ways to buy the close. What you can do is a second or two before the bar closes, you simply hit buy the market. Or as soon as the bar closes, you hit buy the market, and then you get filled on the open of the next bar. Or you wait for the bar to close, and you quickly place a limit order to buy at the close, and you usually get filled at the next bar, or not always. You only get filled if the next bar trades below the close of the current bar. For example, on this bar, if you waited until the close of the bar, and then you saw where it closed, you placed a limit order to buy, you would not have been filled, because the low of this bar never fell below the close of that bar. That's usually not the best way to buy the close. It's usually better just to buy the market at or just before the bar closes. You can buy above the high of the prior bar, looking for a resumption of the trend. The bears tried to reverse. Who thought this would lead to a reversal? Nobody, and therefore the bears would have to buy back their shorts above the high of the prior bar. Here we have a high 2, you get a small double bottom bull flag, a decent looking bull bar. It's a reasonable buy above the high of that bar, and you get filled right here. Do you think the market's going to reverse? It traded below the low of this bar. Do you think this is going to be a failed breakout and a reversal? No, the odds are very high that there'll be buyers at the low of that bar, and therefore you can place a limit order to buy at the low of that bar. And the same here. You have a bear bar, but a tail on the bottom, strong enough breakout for at least a little bit more up. Traders will bet that the bear reversal will fail, and one way to do that is you place a limit order to buy at the low of that bar, and you get filled as soon as this bar traded below that low. You can also buy the close of any strong bear bar, betting that instead of the start of a swing down, it's going to be a bear trap. The bears are going to be trapped into selling a low close in what will become a bull flag, and the bull trend will resume. When the market's in a bull trend, the market tends to spend a lot of time near the high of the current bar. And beginners are always worried about risk. They know where the stop has to be, and they don't want to risk that much because they're always concerned about losing money. They worked hard to get their account big enough to allow them to trade. And if the account size falls below some minimum requirement from the broker, you're no longer able to trade, and your dream of becoming a profitable, successful trader dies. And therefore, it's natural for beginners to focus on risk. As a result, they see a strong trend like this and they want to buy, but they look at the stop and they say, wow, I don't want to risk that much money. And they wait for a pullback. By the time a pullback comes that they're willing to trade, they're thinking, oh my gosh, it's a reversal, not a pullback. And they end up not buying the rally, and they end up not buying the pullback. For beginners, the setups never look quite good enough. Do I want to buy at the low of this bar? No, it might be a reversal. Do I want to buy above this pullback bar? No, it's a bear bar. But experts know that the odds are the market's going higher, no matter what the market is trying to do here. And therefore, they're going to be buying for any reason. And they also know that the trend may go on for a long time, and therefore they don't want to be waiting for pullbacks. When the market is doing this, they got to buy. They just know they have to buy. And if they can't find a small pullback to buy after a bar or two or three, once they decide the market's going higher, they simply buy at the market. When I talk about pullbacks, I usually mean that the high of the current bar is below the high of the prior bar, or the low of the current bar is below the low of the prior bar. For example, the low of this bar is below the low of that bar, it's a pullback. The high of this bar is below the high of that bar, it's a pullback. Pullbacks sometimes are simply inside bars, like right here, where the high is not below that high and the low is not below that low, but it's still a pullback, and therefore it's still a bull flag. On a smaller time frame chart, this would be a pullback. A doji. This doji bar is probably a pullback on a smaller time frame chart. The market went up and it went down. Tail on the top of a bar, that is also a pullback. The market was up here and then it closed down here, so it pulled back. And on a smaller time frame chart, it would be a pullback. A bear bar, clearly a pullback. It's a reversal attempt. An inside bar again, that is always a pullback. It's pulled back from the high of the prior bar. An experienced trader does not miss many good trends like this. As soon as the market is clearly always in long, experienced traders buy. If they do not see a good way to buy in a bar or two, they simply buy at the market. Everybody knows where the stop is. It doesn't matter if you're a beginner or an expert, and it doesn't matter if you buy here or if you buy here. The stop is somewhere down here. Let's say you buy the close of this bar. Everyone at this point knows the market's going higher. Therefore, the market is always in long. You know a reasonable stop is at the bottom of this bull leg or the bottom of the entire bull trend. Both are reasonable. Both are about at the same price. Once you buy, you know where your stop is. You make your position size appropriate for that stop. You don't want to lose more on this trade than you would on any other trade. If the stop is further away than what you typically like to use, then simply trade smaller size. Here we have a strong bull breakout. Let's say you bought the close of this bull bar. Put your stop below the bottom of the entire bull trend, maybe below this bull breakout. Either one is fine. Can you put your stop below the bottom of this 2-bar breakout? Well, you can. It's also around a 50% pullback. It's reasonable, but it's risky. If this is the start of a strong bull trend, it will not fall below the low of this bar usually. The chance of this being a strong bull trend and falling below this bar before going up, probably only about 30 or 40%. And therefore, it's reasonable to use a tighter stop. You can also use a money stop, like 10 pips or 20 pips below your entry price, or you can put a stop somewhere below a 50% pullback, knowing that the bulls will buy a 50% pullback. Here's the rally, a 50% pullback is somewhere around here. You could put a stop a little bit below. You do that if you think the stop is too far, and that's true on any time frame. This is a 5-minute chart, so ignoring what the prices are on the right over here, just look at the shape. No matter what time frame this is, a daily chart, a 5-minute chart, if your stop is too far, you can use a tighter stop as long as it's reasonable. The tighter the stop, the less you'll lose, but the more often you'll lose. If you reduce your risk, you also reduce your probability of success. That means you increase the probability of failure. As long as the stop is reasonable, it does not matter which of the stops you use. Some traders prefer smaller risk, they use tighter stops. Some traders prefer higher probability of success, they use wider stops. And after 100 trades, this trader is going to make about as much money as this trader. The key is using a reasonable stop. If the stop is too tight or if it's too wide, you're going to lose money. But as long as you do something that is reasonable, it doesn't matter which of the reasonable alternatives you choose. Let's say you buy here and you risk 1 or 2 pips. You're going to lose money. Your stop is going to be hit on almost every trade. On the other hand, let's say you're risking 500 pips to make 10 pips. You're also probably going to lose money. It just takes one loss to wipe out 50 profitable trades. Those are not reasonable, and unreasonable stops will result in you losing money. Again, some traders prefer winning a lot, winning often, and they prefer high probability trades, and they'll use wider stops. Other traders are primarily concerned about risk, and they'll use tighter stops, knowing that they'll win less often. Doesn't matter which of these closes you buy, or buy below this bar, or buy above that bar, or buy above this bar. It's all the same trade, and the stop is the same. If you take any of these buys, it's reasonable to put a stop here or here. If you take any of these higher buys, it's reasonable to use a stop down here. Your stop location does not have to do with your entry price. The stop has to do with the bars to the left. If you're looking for a swing trade, your stop has to be below the most recent major high or low. After every strong breakout, traders will tighten their stop to below the bottom of that breakout. This is really, I think, a minor high or low. I think this is really a more important one. Here, a decent breakout to a new high, traders will tighten their stops to below its low. Another strong breakout, you can tighten your stop to below the low of that breakout. The idea is, if it's a strong bull trend, it should not fall below a major higher low. A major higher low is a higher low. This low is above this low. This low is above that low. So it's a higher low where you have a strong breakout, usually to a new high. If the market's in a bull trend, it'll keep making new major higher lows. If it falls below a major higher low, then it's not in a strong bull trend. If you bought on the assumption that it's in a strong bull trend and it falls below a major high or low, your assumption is wrong, and therefore you want to get out. So you're happy if your stop gets hit because you know that your premise is no longer correct and you don't want to be risking more than the minimum. Some breakouts are especially strong and they have a series of bull trend bars, and I call those by the close bull trends. This is an example. Once you decide that the market is going up after 3, 4, 5 consecutive bull bars, especially bull bars closing on their highs, you buy for any reason, and a good way to do it is buy the close. Some traders will buy a close. They'll buy more on the next bull close, the next bull close, the next bull close. As long as the trend keeps making higher closes above the prior close, some traders will just keep adding on to their position. Most traders do not do that. Scalpers will buy the close, exit when they have their scalp, and then they'll buy the next close and then exit again when they have the next scalp. That's really not an ideal way to trade a strong breakout, because what will happen is after you've done it once or twice, you'll be tired and you won't get back in and you'll end up missing a lot of the trade. It's better when you have a strong trade like this that you buy for any reason, use the appropriate stop, and hold on until there's a good reason to get out. Here we have a bull breakout above the trading range and a bull follow-through bar. Reasonable to buy that close. Some traders will buy more on another breakout. They're scaling into a winning trade. They're scaling in at a higher price. And it's reasonable to do as long as you are trading small enough so that your risk is no greater than on any other trade. Most traders pick one entry, use the appropriate stop, and hold until there's a good reason to get out. But some traders will buy and then they get a good profit. They'll buy more, they'll buy more, they'll buy more. And then they'll take profits on their entire position when they have a reasonable reason to get out. For example, as I said, some traders would buy every close as long as the market keeps going up. One of my goals in life is to do that like 10 times in a strong bull trend like this. And I've never done it. I've done it several times, but I've never done every one. Just buy more, buy more, buy more, buy more, buy more. And at some point in my life, I hope that I do that just once, just for the experience of it. Beginners should make as few changes as possible when they're trading, and that includes order placement. When the market's moving up quickly like this, you have to get long, and you can buy closes or buy the market. Right before the bar closes, you can place an order to buy at the market. Right after the bar closes, you can place an order to buy at the market. Alternatively, beginners should simply consider placing a stop to buy just above the high of the prior bar. Once he thinks that the market is in a strong breakout phase, here we have 4 consecutive bull bars, 2 of them closing on their highs, the bodies are getting bigger, we're breaking above a trading range. This is probably the beginning of a buy the close rally. He could buy closes, buy at the market, or simply enter with stops. Enter on a stop just above the high of any bull bar that's closing near its high. Here are examples, these brown boxes. As long as it's in a buy the close rally, these are all reasonable entries. It doesn't matter which one he takes, the stop is still going to be down here or down here. He's not going to take every setup. A scalper might take many setups. A scale-in trader may scale into his position and build an increasingly large position as the market's going his way. But a beginner trader simply needs to get long. The easiest way for him to get long is, once he decides that the market is racing up, place an order to buy on a stop 1 pip above the high of the prior bar. Now, why would traders buy closes? Well, the alternative is to wait for a pullback, and sometimes the pullback might not come for a long time, and when it finally comes, it may look more like a reversal than a bull flag. Instead of missing the whole trend waiting for the perfect pullback, it makes more sense to get in, buy small, rely on your stop, and allow the trade to go as far as it will go. Some traders want perfect trades, but perfect trades cannot exist. Once you think the market's going higher, look at where your stop has to be and buy for any reason, use the appropriate stop, and trade small enough. If you're a trader, you have to trade. You cannot be waiting for perfection because you're never going to see perfection. And worrying that, oh, the probability is only 60%, I want 70, 80, 90% chance of making money. Well, you're never going to trade. If you're going to be a trader, you have to allow for the possibility that you're going to lose money. And most great trades are about 60%. You'll rarely get higher probability than that. And these are all good trades. They all have a 60% chance of making a reward at least equal to your risk. Again, if you're waiting more than a bar or two after you decide the market's going higher and you're still not long, simply buy at the market. Trade small and buy at the market and use the appropriate stop. These are all appropriate stops. If you buy here, stop down here. If you buy up here, once you get that second bar, reasonable to put a stop here. If you buy here, once you get that second consecutive bar, reasonable to put a stop here. Every pullback is an attempt by the bears to create a bear trend. And since most reversal attempts fail in bull trends, most reversal attempts become bull flags, pullbacks. Pullbacks mean that the trend will probably resume. Initially, in a strong bull trend, you get a one-bar pullback or a one-legged pullback like this. Traders buy above the high of the pullback bar, a high one. Here's a pullback, one leg down, it's a high one buy. Here we have a high one, and the bulls failed to get much higher. The bears tried to sell off again, and they failed, so it's a high two. So high one, high two. High one bull flag. You know where the stop has to be. We have another breakout, consecutive bull bars. Here's a high one. You can buy that, or you can buy that, or you can buy both with the stop here. It doesn't matter which entry you take. It doesn't matter if you take all of them. It's important to be long for any reason. And if you did not buy down here, or if you bought and took profits, you need to get long. You know where the stop has to be, and you just take the buy and rely on your stop. Another breakout and a pullback, so a high one buy. Is this a high one or high two? Some computers would see this as a double bottom and call it a high two. Others would say this is a breakout of a high one bull flag, and this is a pullback from this breakout, and therefore this is a high one. Does not matter what you call it, you have to get long. In a strong trend, you'll often get 2 or 3 high ones in a row before you get a high 2 or a high 3 or a triangle or a wedge. However, as the trend progresses, it tends to get weaker and pullbacks tend to become more complex. So instead of a high 1, you often get a high 2 or a wedge. When a trend looks like this and you get a reversal attempt, reversal attempt, reversal attempt, the odds are it's going to be minor. A minor reversal means a pullback, possibly a trading range, but not a trend reversal. So for example, even right here, this is still a minor reversal, a very tight bull channel. Chances are the best the bears will get is a trading range. Once they have a trading range, then they might get a major trend reversal. Here we went slightly higher than this, so a higher high major trend reversal, lower high major trend reversal. But at this point, the first reversal down is minor, which means a trading range, and that means you're probably going to go up to the high again. The bulls expect the bear reversal attempts to fail, and they'll buy for any reason. And one thing they'll do sometimes is buy below bear bars or simply buy bear closes, betting that the reversals will fail, become bull flags, and the bull trend will resume. They'll also buy below bars, betting that the reversal down will be brief and the bull trend will resume, and they're buying at a good price. They expect the first pullback to only be a bar or two, and therefore, if you're buying at the low of the prior bar, the market's probably not going to go much lower before the bull trend resumes. So it's a very good way to buy in a strong bull trend. At some point, a bull trend transitions into a channel like this, and then into a trading range like this. And when it's in a trading range, the first reversal down usually is minor. Bulls will look to enter with limit orders. They'll buy at a prior low, betting against a reversal down, and instead that the market will come back up and test the high like it did here and again here. Once it enters a trading range, they switch their goal into scalps instead of swings. We have a bull breakout. Some traders will buy with a limit order at a 50% pullback, which would be right here. We have a bull breakout here. It never reached a 50% pullback, so these bulls were unable to buy at a 50% pullback. Other traders will buy at a fixed number of pips down, like 10 pips down or 20 pips down. This is 20 pips below the highest bar on the chart. This is 10 pips down. When you're buying early in what appears to be a good bull trend, it's, I think, very good if you can swing at least part of your trade using the correct stop. You can scalp out part of your trade. The probability is high that you'll make money. However, when you have a strong breakout like this, it's always good to swing at least part of your trade. We're still always in long at this point, but we have a nested wedge, 1, 2, pullback 3, inside of 1, 2, 3. It's reasonable to take profits at the end of the session. Also, the bars are starting to get small. It might be entering a tight trading range. You have consecutive buy climaxes here, 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 and then here, and then another one here. When you have a series of buy climaxes like that, the odds are the trend will soon end and convert into a trading range. And that's another reason to be prepared to take profits. Nested wedge, 1, 2, 3. Other computers will say 1, 2, 3, or 1, 2, 3. Another reason to expect the transition from a bull channel into a trading range. Now we have 5 consecutive bear bars. If you did not take profits there, after 3 or 4 decent-sized bear bars, traders expect a couple legs down, reasonable to take profits here. Most of the bear bars are small. However, if you have 5 small bear bars, the odds are high that we're going to test down to some higher lows, like maybe here or here. And you're going to run out of time on the day. The day's evolving into a trading range. I think it's reasonable to exit swing trading and convert into scalping mode, looking to buy low, sell high, and scalp. Some bulls will not get out on this. They'll say, oh, it's a very tight channel, minor reversal. It may pull back for 20 bars, 30 bars, but the odds are it'll get back up here. And if I hold long, rely on my stop, I can let it pull back, maybe a 50% pullback. That's what this looks like. And then buy more again above a bull bar. Like maybe above this bull bar, betting that it'll get all the way back up to the high. And at that point, maybe I'll take profits when it gets back to that high. And you can see we went above the high and reversed down. A lot of the bulls took profits, and a lot of bears sold. The bears sold because at this point, they believe the market's in a trading range and no longer in a bull trend. And they want to sell above prior highs. Had you bought for any reason and used the swing stop through all of this, I think you should get out here. We have a new high, a strong bear bar, a strong sell-off, a strong break below the bull channel, and therefore this might be a lower high major trend reversal. Therefore, it's reasonable to get out below that bear bar. You could also sell, betting on the major trend reversal, but at a minimum, I think the bulls have to get out. By the close of this bar, traders thought it was a buy the close bull trend, and they were buying closes. They were buying at the market. And notice how every open is at or above the close of the prior bar. That's a sign of very aggressive bulls. As soon as the bar is closing, a lot of traders are hitting the button to buy the market, and the result is that some of the opens are above the closes of the prior bars. Small gap up. The open of this bar is above that close. The open of this bar is slightly above that close. It's a sign of aggressive bulls, and it usually means the market's going at least a little higher. The open of this bar is below the close of that bar, and this bar has a bear body. Are the bears going to get a reversal? Probably not after this many bull bars. And that means that this is probably some profit taking on the part of the bulls. And other bulls saw this as a buying opportunity. As soon as they saw this bear bar, they bought the close. And you can see how the open of the next bar is at the close of this bar. That means that instead of traders selling the close, they bought the close, betting that this was trapping weak bears into selling and that it was not going to lead to a reversal. In fact, it was going to be a bull flag and the market was going to go higher. Look at this. We have a small gap up, the open of this bar slightly above that close, and then a bear bar. Instead of buy the close, traders sold the close. This is the biggest bull bar late in a bull trend. A lot of the bulls saw it as an opportunity to take profits. Look at this bar. It gapped above the close of this bar, yet it was a pretty big bear bar. What happened here? It was a buy the close bull trend. The bulls were hoping for a resumption of buy the close, and some bulls bought. As soon as this bar closed, they hit buy the market, and this open is slightly above that bar. But then what happened? Even stronger bears, many more bears, thought that the market was going to pull back, and this was probably an exhaustive buy climax. And as soon as they saw the market gap up, they hit sell, and they sold for at least a scalp. Gap up, bear bar, that's a sign that the bull trend is weakening and that we're probably going to get a transition into a trading range or possibly a reversal fairly soon. When there's a bear breakout and it has a series of bear bars closing at or near their lows, it's the sell the close bear trend. The odds are the market is going lower. Bears are selling at the market, and they're especially selling at the close of a bear bar that closes at or near its low. We have a strong rally, and it's in a very tight bull channel, and it has 3 legs up. It's a possible parabolic wedge top. Therefore, traders will be looking for a reversal down. Usually, you get an endless pullback. It looks like a bull flag, and then at some point, if it's going to become a reversal, you get a big bear bar with a follow-through bar, and that can lead to a swing down. You can see this blue line is the 20-bar exponential moving average on the 60-minute chart, and I wrote an indicator that allows me to plot it on the 5-minute chart. This rally is simply a pullback testing the 60-minute moving average. It went a little bit above, and now it's reversing down. At this point, it's a bull flag. The odds are we're going to go higher. But once you start to get 10 or 20 bars in the bull flag, it's an endless pullback. Traders then start to watch for a possible big bear bar and a follow-through bar. If they get that, the market's now always in short, and the prices are probably going to fall. By the close of this follow-through bar, the market's always in short, and traders are selling at the market, especially on the close of bars. As soon as they see a bar close, they'll hit sell the market, or they'll wait as soon as the bar closes and place a limit order at the close of that bar to sell at the close of this bar. One problem doing that is right here. This bar never went above that close. So if a trader placed a limit order to sell at this close right after that bar closed, he never got filled. It's usually better to sell as soon as the bar closes or a second or two before the bar closes if you think the bar is going to close on its low. You just hit sell the market. Now, why would anyone do that? They're doing it because they think the market's going lower. The reason why they're selling closes in a breakout, they're selling at the low of a bear trend, is because they think either the market will fall immediately and they can make money, or the market will pull back and become a bear flag and then resume down and they'll make money. Or finally, the third possibility that they see is the market reverses up, but the reversal is minor and it becomes a trading range. Therefore, they sell here, and if there's a big pullback, they'll assume it's a trading range. They'll sell more, expecting it to get down to the bottom of the range, where they can get out break even on their first sell and with a profit on their second sell. When you have a strong breakout like this, the chance of a reversal up is probably only 20 or 30%. Very tight bear channel, strong breakout, follow through, 70 or 80% chance we're going at least a little bit lower. Therefore, once you see this, one of two things is going to happen. One, the market's going to go down and you make money, or two, the market's going to enter a trading range and you can either avoid a loss or make money. Only 20 or 30% chance it's going to immediately reverse up. You can see the problem if you see the market as a sell to close market, you wait for this bar to close, you place a limit order to go short at that close. If this bar never gets above that close, you never get filled and you miss the trend. I mentioned earlier that beginners should try to do the same thing pretty much with every trade, and that includes how he enters a trade. While a lot of experienced traders will simply sell at the market when he thinks the market is going down strongly, beginners should consider entering with stops. Once he feels like the market is racing away from him and he's wondering about how to get short, what he can do is simply sell on a stop 1 pip below the low of a bar that closes near its low. For example, these are all reasonable short entries. We have a big breakout bar, sell on a stop 1 pip below the low of that bar. And then any of these bars that are closing near their lows, place a stop order to go short 1 pip below the low of the bar. You do not have to take every setup, but you're trying to get short for a swing trade, so try to take at least one. Bears sell, expecting that they'll make an immediate profit. They can either scalp or swing, knowing that the worst case is it'll either reverse and become a bear flag and then go lower, or reverse and become a trading range and get back down to the bottom of the range. Most traders sell once, use the appropriate stop either here or up here, and hold on for a swing. Some traders will keep selling, adding to their position, scaling into a winning trade. High probability the market's going lower. It's at least 60% probability, maybe higher, and that's as good as it gets as a trader. And if you're a trader, you have to take the trade. Just sell at the market. Use the appropriate stop. Every one of these bars is a sell to close bar. Even this little bull bar probably will going lower, so traders can sell that bull bar as well. Once you start to see 2 or 3 bull bars, then it's probably entering a channel phase and it's no longer sell to close. It's still a strong bear trend and you can sell for any reason. You can sell at the market, you can sell above bars, you can sell bull closes, you can sell below bear bars, you can sell below bull bars, but it's no longer sell to close. Very few experts sell every close, building their position size. It's scaling into a winning trade. Most traders take 1 or 2 trades and then just hold for a swing, possibly scalp out part. If you take any of these sells, 2 choices for the stop, either above the top of the bear breakout or above the top of the bear trend. If the market gets above the top of this bear bar, it's probably no longer a bear trend. It probably has evolved into a trading range, possibly even a bull trend. It's therefore reasonable to use a tight stop here. If you get stopped out and you get a sell signal, you can sell again. If you get a sell the close bear trend at the end of a session, traders will be very quick to get out. For example, they'll get out above a bull bar or 3 or 4 pips above any bar, including above a bear bar. There's too much risk of a reversal at the end of a session. We have 2 bull bars. Bull bar, a resumption of sell the close, and then a second bull bar. At this point, I think it's no longer sell the close. Still a very strong bear trend, but it's no longer sell the close. You can sell the close, you can sell for any reason, but at this point, I would call it a tight bear channel. Traders will sell below bars, pullbacks, low 1 bear flags, low 2 bear flags. And if they get a pullback that retraces 50% of the most recent bear leg, they'll sell a 50% pullback. They'll sell a pullback to the moving average, especially as it reverses back down. Here we did not get that. This is an especially strong bear trend. They'll sell strong bull closes near the moving average, which we did not get either. They'll sell above bars, for example, at the high of this bar, betting the reversal will be minor and the bear trend will resume. A very big bear bar, 20 or more bars into the bear trend, probably an exhaustive sell climax. One of 2 things is likely. Either the bear trend has ended and will go sideways, or maybe we'll get one more leg down and then the bear trend will end. It's reasonable to exit above the high of this bull bar. First attempt to reverse up in a very tight bear channel, probably minor. Traders could still rely on their stop. Or if they get stopped out above this bull bar, they can sell more again below the low of any bar. This is not a particularly good sell. I think most traders would get out above this bull bar, not sell again below this bull bar. If a trader did not get out above this bull bar, now we have an even bigger sell climax, consecutive sell climaxes. And this is by far the biggest bar, more than 20 bars into a bear trend. It's probably an exhaustive end of the trend. Traders will either get out above a good bull bar, this is not a good bull bar, or on a second entry reversal, especially if it has a bull body closing near its high. This is where I think most bears will get out if they're still short. Aggressive bulls will buy this, looking for at least a test up and maybe a couple legs up. Probably an exhaustion gap, a gap between this close and that low, a gap between this close and that low. The odds are 60% or higher we're going to quickly get up above that low or that low and close the gap. We'll probably get to the top of the sell climax bar. Therefore, bulls will buy, looking to exit somewhere around the top of that sell climax bar. I began by talking about bull breakouts, and then I talked about an especially strong type of bull breakout where you get 3 or 4 consecutive bull bars closing at or near their highs. Traders are buying at the market, and they are buying the close of the bull bars. Finally, I talked about strong bear breakouts, sell the close bear breakouts, breakouts that are so strong that traders are selling at the market, especially at the close of a bear bar that closes at or near its low. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 4 videos on trading breakouts.